Today, we are going to be learning directly from one of the market wizards. We're going to learn the 8 keys to super performance for your portfolio. So I'm very excited. Let's get right into it. This is from my friend and mentor, Mark Minervini.
My guiding rules that I actually have a sign up on my wall in my office, and it says no forced trades, no big losses. And I've had that sign up there for a long time. I also have a sign next to it that says losers average losers. And basically, those are the big 3 rules that I always follow. And I know they may sound maybe obvious or simplistic, but believe me, there's these are the things that most traders deviate from the most. And what I mean about forced trades, let's talk about that for just a second. And I'm sure everybody that's a stock trader for any period of time can relate to taking trades that maybe you shouldn't have, or feeling antsy and itchy to do something, so you end up taking a trade, and later on you look back at it and you notice
it's gonna be great. Hopefully this is not the first video you've ever watched on the channel, because you're probably like, who's this random guy on the internet? But the keys that Mark is going to go through in this video are the same ones that I talk about all the time. So you're going to hear directly from the mouth of a market wizard some of the exact same things that you hear directly from my mouth of a random guy on the internet, which is going to be great.
Why did I do that? What the heck was I thinking? That's that pressure to have action in the market. Dave, I'm curious. You've been doing this for a long time, and I'm sure back when you started, this was probably a problem, just like it was for me and for everybody else. How do you deal with that? Do you ever feel the urge to actually put on trade?
So he's talking with David Ryan, one of the proteges of William O'Neill, and William O'Neill wrote this book here, How to Make Money in Stocks. And David Ryan also is a market wizard, also has won the US Investing Championship multiple times, I believe. So, like, if you're going to learn from anybody, why not learn from the people who have figured out how it's done?
It's that maybe you feel you shouldn't, or do you get this kind of pressure on you ever?
Yeah, I mean that's very natural. I mean, for anybody in the markets, you have these emotions weighing on you back and forth. Should I be buying? Should I be selling? And the way you overcome this, and the way,
or should I be sitting in cash and not effing up, right?
You overcome forcing trades is you develop a system or a method that works in good markets and bad markets.
You develop rules, and then you follow those rules to a T.
And so it really comes down to discipline. Do you have rules that you filter every idea through? That's how you get over forcing trades, because forcing trades all comes because you're emotionally in the wrong place, and you're not following some kind of systematic system to eliminate the emotion.
Yeah, and of course you have to have a system first, but having a system and having a set of rules is the very first step. And some people, you may not even have that yet, and you're looking for those rules and that system that you could follow. But then you have to have the discipline to actually follow it. And something that I always try to point out to.
Did he just say consistency and discipline? Right? You need to have trades that have some sort of edge to them, right? You got to figure out what that edge is. But then once you figured out what that edge is, you then need to follow that with consistency and discipline. Like, you legitimately can't just show up one day and be like, this is going to work today. No. You have to show up every day. And every day that comes through, you need to be saying, I'm going to follow my plan. I'm going to follow my plan. I'm going to follow my plan. And even when that plan is just sitting in cash and not effing up, that's part of the plan. Just good. That's okay, right?
New traders especially, is that you have to define what it is you're doing. I mean, if you're if you're a certain type of trader, you got to stay in that area of competence, and that means sacrificing some of the other areas. Main thing is I'm always looking to trade only setups that I am familiar with, that I know what to expect. I'm always trying to keep my losses as small as possible, back into the lowest risk trades possible. And I never, ever.
Wow. It's like he trades risk first. Right? And every day he comes to the market, I bet you he tries to reduce risk, which is what we do as well.
Add money to losing trades. If I'm down on a trade, I'm not going to add to it. That's the probably the ultimate amateur mistake. I'm never ever adding to a losing trade and averaging down. Worst possible.
So let me pull up my slides over here, because there's a great slide. Heard of this slide from Mark, in fact. Because Mark's trading hero was Paul Tudor Jones. This is PDJ right here. And Paul Tudor Jones had this plastered on his wall. Also a market wizard, one of the greatest traders ever. Mark tried to be like him, because Paul Tudor Jones pulled up 3 years in a row with triple digit gains. And so Mark had set that as his goal. He wanted to have at least 4 years in a row to beat PDJ. And that was something he posted up on the wall. Mark told me about this ages ago. Losers average losers. And Mark even said a few minutes ago, losers average losers is something he has pinned up on his wall.
Advice you could get. If that's the kind of advice you're getting, fire whoever's giving you that advice. Real quick, let's just talk about professional trading goals and what that means. To me, professional trading for me means taking minimal risk and then capturing relatively.
Which is so funny, because most people come to the market, they're like, gotta risk it for the biscuit, right? It takes money to make money, right? All the diamond hands, right? That's not how it's played, not at all. You want to take as little risk as possible to see if you're right. And if you're not right, it's okay, right? But you don't want to risk $1 to see if you're going to make $1. You want to risk a penny, maybe a nickel, right? You want to risk as little as possible to find out if you're right. And if you are, you can have giant gains. And if you're not, you didn't waste that whole $1. You just wasted, maybe a penny or a nickel, and you can live to fight on a new day.
Large gains relative to that risk. Now, that word relative is really important, because if you're a day trader, well, a 5% gain is probably going to be a pretty big gain. But if you're a long-term investor, that wouldn't be, of course.
All right, everybody, stop listening to Mark's channel. Mark doesn't know what he's talking about. Everybody go find CC's channel and start watching CC's channel, because CC says averaging down has gotten him out of a lot of losing trades. So doesn't matter what Mark says, the 2-time U.S. investing champion. Doesn't matter what I have to say. Doesn't matter what Paul Tudor Jones has to say. Everybody, stop what you're doing. Go find CC's channel. Subscribe to him, because clearly he knows more than everybody else.
So it's relative to your risk. And then you want to maximize compounding by rolling that over as many times as you can. And again, if you're a shorter term trader, you're going to have more turnover. You're going to be rolling that over more often. If you're a longer term investor, it's going to be less often. So it's relative. Now, one of the things that surprises a lot of people is when I tell them that I want to be in the market as little as possible.
Yo, who's that sound like? I want to be in the market as little as possible. All stocks are bad. Listen, all stocks are bad, but every once in a while they act right. It's almost like this guy mentored me.
As a matter of fact, if we circle back to when I won the U.S. investing championship, that entire year I was up 155% that year. And if you looked at the whole year and like averaged out my exposure in the market, I was only in the market about 50% of the time. So if you take 12 months, on average, 6 of those months I was out of the market. So
what do you think he was doing in the meantime? Bro, in the market 50% of the time. Put it in the chat. What do you think Mark, one of the greatest traders ever, was doing when he was not in the market 50% of the time? I bet you can guess. I would bet he was sitting in cash and not effing up. That's what I bet he was doing. 50% of the year, bro was sitting in cash and not effing up. And you know what he did? He won the U.S. investing championship sitting in cash half the year, because it made sure he didn't F up. Right? These are timeless principles.
I achieved that return, and many of my big return years have been achieved with being out of the market. And that's because when you're in the market, you're at risk.
Did you just hear what he said? Many of his big return years were achieved by being out of the market. Good luck with understanding that one. Unless you understand that you only get in the market when everything is set up perfectly. Elsewise, hold cash.
Risk. So I'm trying to be in the market at specific particular times. And that leads me to the first key to big performance, and that's timing. Dave, you know, a lot of people say you can't time the market. You know, I mean, I always say anybody who says, you know, you can't do something, it's because they can't do it, and they don't believe somebody else can do it because they can't see themselves doing it. But you know, you and I have been timing stocks for, you know, decades now. You know, what do you say to that? And then what any, you know, advice for getting over, you know, having that limitation in your thinking?
Well, the timing is coming down to looking at how a stock is acting, and there's certain patterns that repeat themselves over and over again, especially in successful stocks that are in uptrends. They act a certain way. So once you identify a base, or how a stock breaks out or starts a move, or even in the middle of the move, or when it's topping out, if you can identify that by looking at charts and studying them, then you can get down to the point where you're buying just as the move is starting. And I've just, you know, I've looked at probably millions of charts now, and have studied them, and looked at these moves, and they're defined patterns that show up over and over again. So to say that you can't time the market, I would just say, well, I'll show you so many charts, so many different situations where the timing, it worked and it continues to work. It's the same thing. The other thing, you can look back at charts going back into the 1930s and 20s, and even I've seen charts of even below 1900, where the same patterns repeat themselves over and over again. So timing is done by looking at charts, and it continues to help in finding the best stocks to buy.
Yeah, and charts are just showing the price. I mean, it's not, there's nothing magic about them. It's not like it's a precursor to anything. It's actually the end result. So it just,
You know, I think of charts as like a history book, right? Like in the history of time, what has happened to individual stocks, right? So in the SPY, in the history of time, it's been a pretty consistent rise, right? We've all heard the market going up, you know, 8% over year, no matter what. There's been some dips here and there, right? But that's the history book of the SPY. Then we can go to Tesla, who's had a very different history, right? Tesla's had an extremely volatile history, right? The history showed this move going up 124%, and the history also showed this move 100% evaporating after that point, right? That's how I look at charts. It's not that it's anything magical, but it's telling you what is the stock doing today. Is it trending up or is it trending down? And it's also showing you what has happened in the past, historically speaking.
showing the price. But even Warren Buffett is timing his trades. You know, maybe they're based on a different factor. Maybe he's not even looking at a chart. You know, he's looking at fundamentals, but when those fundamentals deteriorate, he's out. When he sees the right valuation, the fundamentals, he's in. There's still a timing mechanism. You have to make a decision to buy, a decision to sell. So that timing factor, you know, I think the big point that people have to realize is that you're not going to make big returns in the market. When I say big returns, I'm talking about 40% a year or greater is what I always shot for as my minimum level. And
so my gains since 2021 have been compounded 44% per year. Now I've had some big years. 2021 I was up 172%. 2022 I was down 20%. 2023 I was up 5%. 2024 I was up 91.37%, right? So we can't tell the market when we want to get paid, but over time, compounded annual growth rate for me was about 44%. It's nowhere close to mark, but it's still pretty good, I would say.
What I really wanted was a triple digit a year. That's what I always shot for, was that triple digit year. I had a lot of years that I was able to do that. About 75, 80% of my years, I had triple digit years for over a decade. But then, you know, on the years that weren't so good, I wanted to return 35, 40%. And then if there was a real big bear market, you know, if I broke even or just had single digit losses, I was happy. But regardless, you're still going to have to have some sort of timing. And people think that you could just put a stock away and hold it. Doesn't work that way. I mean, even if you do get onto a long-term winner and you put it away, when it really all comes down to it in the long run, you're not going to get those consistent returns where you're making a career out of this. And you're.
All right, doesn't this look like Tesla that I just showed a minute ago? Doesn't this look like Tesla? I know he's going to go here in a few minutes, so I'm going to beat him to the punch. We are going to go take a look at what is called the market cycle. I actually learned this from Mark. He was talking about stage 2 uptrends, and I'm like, what in the wide world of sports is a stage 2 uptrend? So this is what a market cycle looks like, which looks a hell of a lot like that. Looks a hell of a lot like that. Now, stage 1 is this basing pattern down here, where it's trying to figure out where it's going. Stage 2 is the big run. This is the one where everybody feels like a genius, right? Stage 3 is this topping pattern where people are excited to get in, but they have no idea what they're doing. And in fact, I bet it looks exactly like that on the top of Tesla. Huh, weird. That's where the moving averages start crossing over. And it's weird because it's like almost a real thing, right? And then stage 4 is this downtrend that people want to buy all the way down because they think they're geniuses and that it has to go up, but it could go down for months and months and months and months before it even hits the bottom, right? So yeah, I know he's going to go there, but I also wanted to say, what's up, Thomas? Bro, I have the best job in the world as a full-time YouTuber and trader. I couldn't imagine what a better day than to sit in cash, eat popcorn, and watch one of my friends talk about how to trade stocks.
And you're making a living off of it. That requires some trading and some timing. I want to point out something that that I call the 50-80 rule. And as much as I've pointed this out and I've talked about it in my books and so forth, a lot of people don't realize that the big market leaders of one cycle, when they finally top, when you get a big secular move and it tops and it was a key leader, the chances of it going down 50% are about 80%, and the chances of it going down 80% are about 50%.
Okay. The chances of it going down 50% are 80% of the time. The chances of it going down 80% is 50% of the time. Now, I'm going to get lots of hate from the SoFi bros because SoFi, I don't know if it's going to happen, but it's just Chris's guess, just Chris's opinion. I could see this totally happening. Now, in fact, SoFi did a little run like this, so let's measure this guy out. So it went up 123% from here to here. And how far down did it go from here to here? It went down 50%. Huh. It's almost like Mark knows what he's talking about. 80% of the time, it'll go down at least 50%. Now it's gone up since this low right here. It's gone up 158%. I'm not calling for a 50 or 80% crash, but I'm saying I wouldn't be surprised at all to see it pull back down. SoFi bro is going to kill me. It's just true.
And the average leader when it tops goes down about 70-75%. Now that's a huge decline. If you have a portfolio of these big high octane names that are doing great in a bull market, and when they finally top, you could be sitting at a huge loss, lose everything you've made and even more. Now this is an example of Lumber Liquidators, which was a market leader coming out of the 2012 market and had a big move, and then of course you can see gave up everything. And this isn't something that's new. This happens cycle after cycle. David pointed out you could look at charts going all the way back. We've looked all the way back to the 1800s, and it's exactly this.
This is an interesting scale on the chart. So if you look on the right-hand side, it goes from 15 cents up to $5. So this huge move, right? And then it went sideways for 16 years, right around the $20 to $25 level. I don't know why he chose this particular chart. It's weird, but it really illustrates the point of this is the stage 2 uptrend you want. Stage 4 is where it came down, and then the stage 1 lasted 16 years going sideways.
Same. It happens the same way every time. You'll see the same patterns develop. You'll see the same type of emotions taking hold of people. Holding on to the.
Oh, and to that point, right? There are jokers on the internet that'll tell you to buy a stock as they're going down, and we don't know. Cisco is a perfect example of how you don't know. Bro, you don't know. Going from 15 cents up to, it's really hard to tell, 20, maybe 35. No. Scale goes crazy on this. Bonkers high, right? Infinity higher. And then it came down, stage 2, stage 3, stage 4, it came down, then sideways for 16 years. I'm not waiting 16 years for my money to come back. No way. A lot of people did. A lot of people still do. Because they think you need to buy it when it's on sale. Mark will tell you the exact opposite, which I'm sure he will in a couple of minutes.
the big high-flying names that have been going up for a long period of time, and then when everybody wants to own them, like back in the 90s, you had Qualcomm, JDS Uniphase, you had even Amazon back then was a big leader, Yahoo, EMC, and when these stocks finally topped and became household names, many of them were down 80–90%. Some of them went completely out of business. And then,
now I know it sounds crazy, but this can happen to Palantir. Palantir Bro is going to kill me too. This could happen to SoFi. This could happen to AMD. This could happen to HIMS. This could happen to, you name it. It can happen to any of them, which is why all stocks are bad and every once in a while they act right. Your job as a trader is to recognize when they are acting right and also recognize when they're not. When they're not, guess what? You can do all kinds of amazing trades in 16 years, or you can sit in one stock waiting and hoping and praying it comes back.
Dead money for 16 years. Dave, we've seen this. How many cycles have you seen this? The same story, 87 top, the 90s. Now, going into this market with the FANG stocks, those will probably be something we'll be talking about 10 or 20 years from now. Let's talk about roll back a little bit on timing. Okay, so for those of you who have read my book, you probably know about the volatility contraction pattern, or that vernacular, and how this is nothing new, as far as Dave's been doing this and O'Neill's been doing this for a long time. I just came up with a sort of an overlay, a way to look at, say, like a cup with handle or some of these patterns, and have.
So I'm going to point out a couple differences between Mark and I real quick. First, Mark does patterns. I can't do patterns. I am not an artistic type of person. I'm an analytical type of person. I like math, right? So he's going to be talking a lot about VCP. That's his trademark pattern there. But in a nutshell, if you had to draw on this where the moving averages were, I'm telling you for a fact, mathematically speaking, the 10 was over the 20, price was over the 50. Now, there are times where you might make a buck or lose a buck here and there, but you will be on the right side of the trend when it launches, even if you aren't finding the exact buy point, because maybe you're like me and you struggle with drawing patterns, right? When I look at patterns, I always say it's like a 9-year-old with a fresh new crayon. Right? It's not for me, but that doesn't mean it can't be for you.
Just a little bit better way of determining when one was actually setting up constructively, because I found over the years a lot of people would come to me and say, hey, is this a cup with handle? And it just wasn't a very good setup. So I came up with this volatility contraction idea, and it's really helped people quite a bit. And this is something, again, that we can't cover everything here today. If you want to spend a few days with us and we go over this stuff with 400 pages of workbook material, you can attend the Master Trader program, and maybe in the future we'll be able to do like a technical analysis webinar, but we're going to touch upon some.
By the way, the Master Trader program does not have a money-back guarantee. And it's very, very expensive. But it does have a free 100% money-back guarantee, OVTLYR University.
Ready? Let's go! Respect is earned. Respect is never given.
Right, every Tuesday and Thursday, we have a class of gentlemen who come and attend live, and I teach them everything that I know about trading. Now, you can be like 50% of the people who watch my videos and don't pay attention and listen to it in the background, and nothing's going to happen in your life, right? It's going to go one ear and out the other. You could be like 25% of the people who watch our content, and they listen to something, they don't implement it perfectly, and you know what? That happens. But then they come back and they say, Chris is a scam, this is a fraud, he's a fake guru, he doesn't know what he's talking about, he's only averaged 44% a year, that's nothing, I can find 44% in my couch cushions, don't listen to anything he says. Yeah, by all means, don't listen to me. I'm just a random guy on the internet. Or you'll be the 25% who create generational wealth by listening to what we give away for free here on YouTube and OVTLYR University. And the best part about it, as Launchpad McQuack says right here, it's one of the best classes on the internet. The best part about it, it has a double money back guarantee. Exactly. Because it's free here on YouTube. That's the joke. All right, let's get back to Mark's video here.
things here and stick to the bigger concepts. But you should, definitely, of course, O'Neill's book is probably one of the greatest books ever written on the stock market. I think my books are right up there too, and I think they all work very good together. So you can learn a lot about that by just reading those books. I think if you just read O'Neill's book and my two books, you don't really need anything else, and you'll learn a lot about this. But the timing, I want to be going into these stocks as they're coming out of these consolidations, and you'll notice how the stock is moving very quickly. See, this is where you're maximizing that compounding. You're timing that trade at a point where it's either moving very quickly or it's moving maybe against me. And that's also, you may not like having a loss, but if I'm going to have a loss, I want that loss to happen pretty quickly.
That's what I say. That's what I just said earlier, right? You want to find out as little as possible, or spend as little as you want to spend as little as possible to find out if you're wrong. And if you're wrong, that's fine. But at least you don't spend a lot to find out if you're wrong.
To know, because then I can move on to something else. It's sort of like, would you want to be in a bad marriage for 20 years? And no, I'd like to know right away that this isn't going to work, and then I could find someone else that's right for me. I mean, that's the way you have to look at a stock. You want to try to know. So by timing your trade and knowing what to expect, knowing whether you're right or wrong very quickly saves you a lot of time, and time is money
Mark,
in the
I would
market.
also add that you not only have to look at the chart itself, but also look at the volume, because when a stock is contracting and it's getting tighter and tighter, the volume is usually drying up. And then when the stock comes out of that, starts breaking into above the base, then the volume really picks up. The demand should really pick up. If it doesn't, then you've got a problem, and it's probably going to reverse and start breaking down.
Yeah, and that's a perfect time. Let's talk about breaking down. Not all these patterns are going to work, all right? And when there
you go. To Thomas's question, right? No, not all the patterns are going to work, but they're going to at least set you up in the right direction, right? And that's the thing, is that we can't have any expectations on the trades. Legitimately, Mark is not going to put on a trade and say, I'm going to make 43% on this trade. Because he doesn't know, right? But what he has seen historically is that these patterns have repeated on winning trades, and they have not repeated on losing trades, right? And so when you're evaluating your trading plan, you want to find the characteristics of the winners and the characteristics of the losers, and you want to evaluate them against each other and say, what do these guys have that these guys don't? And vice versa. What do these guys have that these guys don't? And then you want to marry the two and say, I want more of this, less of this, right? Now, to the point about averaging down that we talked about earlier, this is exactly what can happen if you average down. I don't know if you can read this, but this is $550 a share at the time. And if you average down, we don't know where the bottom is going to be. But I guarantee you, if YouTube existed between 2007 2008, there were people screaming, buy the dip, buy the dip. It has to go up from here. This is Citibank. Oh, this is the financial collapse. Okay, all right. People were screaming, buy the dip. It has to go up. There's no way they can go under, right? And the stock goes down 90% basically. Bro, if you decided to buy the dip all the way down to average down your cost, I got news for you. If this stock was actually going to have a giant up move and you bought it at the same price while it was going up versus while it was going down, you have the exact same average price. But one of these gets you to profit so much faster. The other one makes things worse. It's like taking your money, setting it on fire, putting it in a garbage can, go getting another stash from the bank, setting on fire, throw it in a garbage can, go grab another bit from your mom or dad, set it on fire, throw it in the garbage can, and just hope for the best. And for the exact same price, you can find a stock that might be moving up, right? I'm not saying that you're going to find a stock that goes from 500 or 50 to 550. But if you did, and you bought it at the same point, you would have literally to the penny the exact same average price, because it's just math.
As long as you know your criteria is sound, then you'll have a pretty good idea that the market's not right. See, if your trades aren't working, there can only be one of two things wrong. Either one, your criteria is flawed, or two, the market's just not right at that time. It can only be one of those two things. If you have solid criteria and you're buying at the right point, well, then the only thing that's going to hold that back is a negative market, is a hostile market. But if you have poor criteria, you might be in a great market and you're not doing well. So you have to go back and check your criteria. If it's sound, then you have to realize there's times where you're going to get stopped out. And here you go. Here's a perfect example of another. And I wanted to show during this webinar, I wanted to show some of these very high quality, quote unquote, quality companies and what happens to them when they top. This is going into the subprime debacle, going into 08, 09, and here's Citigroup. Again, another name that has never come back. And most of these names, banking names, have not come even back to their break-even points. But you should be selling stock as it's coming up. Just like David said, volume picks up. Volume's picking up on the downside here. Your sell rules are getting hit. You should be out of this stock, and you're never in this. And of course, this will not meet your trend template criteria. Once it starts rolling over like this, all that criteria goes out the window, and you're not even going to be thinking about owning a stock like that. And you would have saved yourself a lot of aggravation here. So I'm looking to time my trades based on the trend template and looking for those VCP patterns.
The trend template, Mark's is a little different than mine, but we still have a trend template.
But also, I'm going to admit when I'm wrong very quickly. And
that sounds familiar.
And like I said, I want to know I'm wrong as quickly as possible. Time is money in the market. Turnover. All right. Here's another thing that you hear a lot about. Turnover is bad. You got to pay taxes. You don't want to.
I haven't heard that argument in a minute because I think I proved my point out on that. Paying taxes is a byproduct of being a badass, right? Hear me out. Would you rather not pay any taxes? Well, I mean, nobody wants to pay taxes, but would you rather not pay any taxes because you had all kinds of losers that you didn't want to close? And so, now you justify to yourself, well, I didn't have to pay taxes on it. Or would you rather have 44% growth in your account per year? And because you have 44% more in your account than you did otherwise, you get the opportunity to pay taxes. I know which I would do, but what do I know? I mean, you do you, but I would much rather pay as much taxes as possible because that means I am a badass at my job, which is making money by trading.
Take that profit. Well, I mean, if you wait long enough and you have losses, you won't have to worry about paying taxes. I want to pay lots of taxes. I want to have lots of profits, make lots of money, and pay lots of taxes. That taxes are good. It means you're profiting. But again, you're gonna have to turn your portfolio over. Okay, you're gonna have to do some work. It's not there's. Just putting into a basket of names, and by the time you see a basket of names like the FANG names or something, and you see this huge outperformance, believe me, the best is behind you. And once it convinces you that you could just salt it away and everything's going to be okay, trust me, you got a big problem coming down the road when you least expect it. You've got to turn over your portfolio, and that means cutting losses very quickly when you're wrong, and selling stocks when you have profits and nailing those profits down. Turnover is not taboo. Turnover is a good thing as long as you have an edge. I want to talk about opportunity cost. People think that when I made all these big returns, especially in the 90s, because so many stocks went up huge. I had these giant winners. And there's a lot of these names that I bought right before they made huge gains. Yahoo is a perfect example. I bought Yahoo, it doubled, I sold it. I bought it back, it doubled again, I sold it. I bought it back, it went up about 40%, I sold it. I bought it back again, it went up 30%. When it was all said and done, I don't know what my compounded return on Yahoo was, but it was hundreds of percent, but it went up 8,000%, okay? A lot of the trades that I've done are swing trades. They're shorter term in nature compared to the big moves. So if you can find one stock that goes up 75%, well, you can get the same result by finding 3 stocks that go up 20%, or 6 stocks that go up 10%, or 12 stocks that go up 5%.
What do you think is hardest, right? One at 75%, finding the one stock that goes up 75%, or finding 12 stocks that go up 5%? Which one of these do you think is the hardest to do? I would venture to say finding one stock that goes up 75% versus 12 stocks that go up 5% compounded. Because 5%, that hurdle, that's not very high. 75%, nearly impossible. Nearly impossible.
If you compound that out, you have to, first of all, define what your strategy is and decide what's going to be the easiest route. Is it easier to find 3 stocks that go up 20% or 6 stocks go up 10%? I think so. For me, it is. I'm better at finding those stocks than I am at finding a handful of stocks that go up 75%. So I'm usually in that category. This would be the more of a short-term trading category, a very short-term sort of scalping. That's not my my wheelhouse, but my wheelhouse is in that 10 to 20. When I get a big winner, it might be 35, 40, 50%, and I'll nail that down. Dave, I'm curious because of course, when I was starting as a stock trader and reading about you winning the U.S. Investing Championship 3 years in a row, that's what got me interested in entering the U.S. Investing Championship. Were you making those big returns because you had some giant winner, or and I know it's evolved over time. I know back then we did have bigger winners, and now we're all trading a bit more. But I'm just curious if that particular time was a result of big winners, or did you also have some of these these quote unquote shorter term trades?
Yeah, but, at that time when I was winning those championships, they were shorter term trades, but they weren't trades where I was in for 2 days or 3 days or so. I would probably I'd hold them for at least a couple of weeks, or if not a month or two, and get these 30, 40, 50% moves. And when I felt that those were getting tired, or that individual stock was getting tired, then I would shift and I'd move into something else. I was constantly looking for the next breakout, the next big winning stocks that have all these characteristics. And so I'd be rotating my money from stock to stock. So yeah, there were a lot of shorter term trades, but it's not day trading. It's more weeks and then some months. And when I really like a company, I don't want to lose a position in it and completely sell out of it. I might cut the position way down and keep a token amount until it rebuilds a base, and then I come back and I buy back.
Yeah, you're going to find that the traders that are getting the big returns consistently, that's the key, consistently. I mean, you can have a big year every now and then, you get a bull market and you're in the right names, but to consistently turn out big returns year after year, you're going to find that it comes from timing and turnover. And as you're hearing, David's talking about having turnover. Even back, this is in the 80s, when trading was really, we didn't do short-term trading back then much. It was really a cutting-edge thing to trade in and out, because commissions, there were so many things against you at that point. Right now, it's a really great time to be a trader. You have just so many benefits of very tight spread.
I fall into the swing trader category. Day trader, I've tried a day trade many times. I've tried with options. I've tried with futures. I just can't do it. I don't want to be stuck in front of the computer all day. Like, I don't have the temperament to sit there and watch these moves. I would get all kinds of anxious. I would get all kinds of excited. It was so much harder for me to follow my plan. Even when I had a plan, even when I could automate a lot of the rules, it still was not where I wanted to be. So I don't know if I made it or lost any money, but it wasn't enough either direction for me to really remember. So there you go. It wasn't enough wins or it wasn't enough losses. But I've made tons of money swing trading, right? Tons of money swing trading. And for me, swing trading is greater than 1 day, less than a month, basically. A long-term investor, you decide what that is. Clearly, my perspective is jaded, but I would say if you're holding anything for greater than a month, you become a long-term investor. Maybe 6 months, right? I'll give you 6 months for swing trader. But for an investor, I feel like they decide to come up with excuses. Okay. And the issue with being a quote long-term investor is a lot of people will hang their hat on it and say, you know what, I'm a long-term investor. I don't care if there's a pullback. And then you're like Citibank going from 550 to 50. I'm a long-term investor. I'm not really worried if the stock's not going anywhere for a while. I can sit on it. Cisco, 16 years later, you're sitting on the same price. I think by calling yourself these different names, you act differently. And a long-term investor, a swing trader, and a day trader all have the same objective. It's to buy it at one price and sell it at a higher price. The duration really shouldn't make a difference, in my opinion. If you get your exit signal, it's time to get out. How long that exit signal takes is really dependent on your style of trading.
And just incredible access where you can trade off of your phone, and commissions are so low. So it opens up a lot of opportunities. You need to define your style. Go ahead. I'm sorry.
Yeah, and Mark, if I could add, I don't think I've ever thought about taxes when I'm in a stock and thinking about selling it. I've never said, you know, I've got to go long term and I've got 4 months to go. I always base my decision on how the stock is acting, and if it should be sold, it should be sold regardless of taxes. And one last thing is that, you know, so many people have IRAs and Roth IRAs, there's no tax consequences within.
Oh, yeah, great point. I have multiple accounts. One of them is an IRA that I trade in. Bro, doesn't stop me from doing anything. I trade the exact same way in all my accounts on the same day, in the same, 5-minute window. So if you can have an IRA, that's even better.
In those, and so they don't even have to worry about
Yeah, it's a very ignominious way of thinking. When you start thinking about taxes and those type of things, you're really thinking very small, and you're missing the big picture. The big picture is to make big returns, and I know a lot of people don't believe they can do that. They don't, but again, I mean, I can't fly a 747 either, but I'm sure if I got the training and I went through the classes and became a pilot, I'd be flying a 747 several years down the road if that's what I chose to do as my profession. So you just need to get the proper training and then spend the time getting the experience. But you can beat the market every year, and you can do really well and make big returns just like we're doing. It's not something that we're naturally gifted with. One of the keys is to make sure that you define your style and you stick to, at least in the beginning, you really want to perfect something and get good at a particular style before you start drifting off of it. You don't want to have style drift. That's the first thing you want to make sure, that you don't have style drift. Now, if you're a day trader, you're going to sacrifice bigger moves, but you're going to have the comfort of not holding overnight. You'll have no overnight risk, but you're probably never going to have a 50 or 100% move like a long-term investor would. If you're a swing trader, you're going to maybe sell some stocks that are up 20 or 30%, only to watch them go on to become 50, 100, 200% winners or more. So there's a price to pay, but you have to realize there's benefits and there's good things and there's bad things about every approach, but you're in your particular wheelhouse. That's your limitation, but there's a benefit from it. So, I find people are constantly thinking there's a better way. You do it this way, and then when it doesn't work, they switch over to this one, and you end up being just a little bit okay at a bunch of things instead of being really great at one thing. And the reason why I've done so well, and I think David's done so well, is we've stayed with a particular style for decades. We didn't just commit to it for a year to see how it does. We believed in it. We realized it's timeless, and we've stayed with it. We've learned everything about it, and that's what I would recommend that you do too. And it doesn't matter if you're picking my style or some. That's irrelevant. Well, there's lots of ways to skin the cat. My strategy is not the only way, but there's many ways. But you want to stick to one of them and really learn it and become great at it. I'm going to talk about the next two keys, and they're basically, we're going to talk about them together. Concentration and risk-reward management go hand in hand. And the reason why is, again, you're not going to make big returns if you're wildly diversified all over the place. You're going to have to get concentrated. If you want big returns and you want to consistently churn out big returns year after year, you're going to have to get your portfolio concentrated. You're going to have to get away from thinking that diversification is going to protect you and that diversification is a good thing for your portfolio. It's not. It's not. To a certain degree. But diversification is just going to limit your upside, and I'm going to show you that mathematically in just a second. But it's all based on how you manage your risk reward. If you're playing this upside down and you're not doing very well, a good job at managing your risk reward ratio, well, then the more concentration you have, the more you'll lose. If you have a negative, if you don't have an edge, you don't have a positive edge. Let me show you some math here. This is just we have a little calculator that.
Ooh, I love math.
We have on for my members that you can put in your various parameters and then see how they would play out. We call it result-based assumption forecast. So if I took a $100,000 portfolio and I had a position size of 10%. I used 10% position sizes, and my desired return is 40%. I have an average gain of 12% and a loss of, an average loss, that is, of 6% with a 50-50 batting average. So half my trades are 12% winners, half my trades are 6% losers, right? I take that and I take a look, I put it into, we call it the hopper, and we look over here. It's going to take 134 trades to get to that 40% return. Now that's doable. I've done I've done 250, I've done 500 trades in a year, swing trading. So that's very doable, right? So now let's just take and we'll up that position size to 25% now. And I'm not saying that every one of your trades should be 25%, but this is what I shoot for. When I try to get built into a position and have some of my bigger positions be 15, 20, 25%.
Guess how many trades you can put on at a time if your position size is 15 to 25%? Very many, like 4 to 8, maybe 9. That's what it was like for me a couple months ago. I was completely full in 8 trades. My position sizing ranges based on the volatility of each stock, because I size for risk versus size for portfolio. But portfolio size generally comes out around 12 to 17%, give or take. You're not going to get that many trades on, right? And you really don't want that many trades on. Sounds crazy, but when you concentrate into something, you don't want the diversification, right? If you found a stock, like he's showing examples where they're going vertical, and it's 2% of your portfolio because you feel that you need 50 stocks at all times to make sure that you are adequately diversified, it's not going to do anything to your account. But if you put 25% or 20% of your portfolio in the one stock that's going vertical, then it's going to make a big difference to your account. It's going to make your account grow bigly. So I am completely in line with what Mark says here, which is you don't need to diversify. I think Stanley Druckenmiller said, Market Wizard said, put all your eggs in one basket and watch that basket as close as you possibly can. Something like that. Never take your eyes off the basket. And that's exactly how traders achieve super performance.
Of my portfolio. Now that same 40% return is going to be achieved with just 54 trades. So see, you have to do far less trades. Now, if we take a look here, we do 134 trades with that same concentration. That gets us 100% return now, doing the exact amount of trades as we did before. Now, of course, if you're, like I said, if you have a negative expectancy, raising your exposure is going to actually hurt you more. So you have to be a profitable trader. But once you are a profitable trader and you're managing that risk reward, it's important that you realize that you don't want to be too diversified. So we covered timing.
I would like to point out that Skinny Buff Guy just noticed that I've been snacking a casual shirt. What's happening in this channel, my friend, is that Chris is sitting in cash, not effing up, following his plan. And when you follow your plan, like I don't have any stress in the market right now. I've been spending probably 6 to 10 hours a day, maybe more, maybe 12 hours a day. And if you include my sleep, because I can't stop thinking about it, another 6 hours at night because I don't sleep all that much. So I would conservatively say 18 hours a day I'm working. I don't mind if I kick up my feet and have a little popcorn while we listen to Mark. But yeah, dude, we're doing so much research, so much R&D on the 4.0 coming out for OVTLYR. Oh my gosh. I asked Mahesh today, like, if I could get a list, because I'm gonna start teasing you guys with all of it. But literally every time Mark, Mahesh, and I meet, we give Mahesh more to do. He's like, stop with the scope creep, stop with the scope creep. But it's going to be awesome. So yeah. Vaclav, bro, you're amazing. Oh, wrong button. Here we go.
Turnover, concentration, risk reward management as
yes, absolutely wearing shorts. Why would I ever wear pants?
4 key principles to get superior performance. Now we want to talk about drawdowns, because when it's all said and done, I mean, I had clients, I'm not going to mention any names, but we had one client, they managed a hedge fund, and they literally were up over 1,000%. The hedge fund was up over 1,000%. a year and a half later, they were down over 99%. And the
Whoa. I was choked on some popcorn here. Whoa. Up 1,000%, down 99%, which means they're completely bankrupt. Bro.
The funny part was they sent out a letter to their investors and they said that they felt they could get it all back within 12 months, which was extremely comical. They eventually, of course, went out of business, but they were hugely leveraged, and in Qualcomm and some of these names that were the big high flying, and they were leveraged. But drawdowns are really, and if there's anything that, if I look back at my career and my performance in the market, I'm proud of the fact that I had a lot of big years and I've gotten a lot of those triple-digit years, but it would be meaningless if I gave it all back in the bear markets. What I'm really proud of is that 88% of my months have been positive, and almost all my quarters, I've only had a few quarters in several decades. In several decades, I've only had a few quarters that were even negative, and they were all single-digit. So this has really been the key to my success. And I'm going to go over with the 4 principles of how I'm achieving that. Dave, as far as drawdowns are concerned, I know you had early on, you had where you were up big and then you gave it back, and that was sort of a big lesson for you. Any words of advice as far as drawdowns are concerned, and your own story, what you learned from it? And
Yeah, you should use. We can go through this. Teach you all these rules, and you can read all the books that Mark's put out and Bill's put out. But a lot of this is learning from yourself. And so when you do have a drawdown and you do get hit, the market, it takes money away from you. Don't get so down on yourself, but take it as a learning experience, because what I did is when I first started out, I took an account and I doubled the account, and then I lost it all back and more. I mean, I went from 30 to 60,000, and I came down into the low 20s, and I spent an entire weekend going through every mistake that I had made for the last year, and I learned from.
Somewhat like what we were talking about earlier, right? My account got up over 60% at one point. Then I had a losing streak, and now I'm up like 24%, give or take. And doing exactly what David Ryan's talking about here, which is taking a step back, evaluating, let this be a mid-year review. Say, what can I do more of that helps? What can I do less of that hurts? It's exactly what we're doing.
Those mistakes, and I said, I'm going to get so disciplined, I'm only going to look for this exact setup. And when I got down to that point and got that determined to only look for that setup, that's when my performance started taking off. But it all started from studying my mistakes and learning from what I had done.
Dave, are you ever buying a stock?
And you're never going to know your mistakes unless you keep meticulous records, right? A lot of people don't. A lot of people, they come into the market, they just start buying this or that, don't really even have a plan, don't know what they're doing, especially don't know where they're going to get out. Watch the stock go up, watch it come back down, then say, I'm a long-term investor, I'm just going to hold it forever. And then, 2 years later, they're still not to break even. And all they had to do was just follow a plan. But if you are trading, you've got to keep those records to know which trades worked, which trades didn't, and then be humble enough to say, okay, it's time to review. What did I do right? What did I do wrong? What outside forces had an impact on this? What things could I have accounted for? What things could I have not accounted for, right? This year, the golden toilet tweets, we can't account for those. There's no possible way that we know when Donald Trump is going to pull out his 2 thumbs while he's sitting on the toilet and say something that's going to tank our portfolio. It sucks, but it is the new reality. And I've seen people who are on the live stream, and they're like, you know what? We probably shouldn't trade when Donald Trump has access to his phone. And it's like, so I guess you're going to be trading in 2028? Because it ain't going to happen anytime sooner than that. So you've got to make sure that you keep track of your trades and, figure out the things that are working and not working.
That's plummeting.
Oh, no. I'm usually always buying a stock that's going up. There's no reason to buy a stock that's in a downtrend or a stock that's getting hit extremely hard, because there's a reason why they're getting hit like that.
Exactly. Right. You want to be buying stocks as they're crashing up, not buying stocks as they're crashing down, because they're crashing down for a reason. Do you really think you're going to be the one person who buys the exact bottom and it's only going to go up from there? It's impossible. Why try? How about you wait for your trend template to tell you it's moving up now? Now's the time to get in. And it's so much easier. So much easier.
That either the bad news has come out, earnings have slowed down, or sales have slowed, or something negative is happening. I am always buying a stock that's in an uptrend that's maybe coming out of a base after
you want all the direction going in your direction. So rule number one is to always trade directionally. And when I say directionally, that's the trend, the long-term trend, the intermediate-term trend, the short-term trend, and the action that's happening that day as the stock is moving.
It's kind of like he's talking about the OVTLYR Nine, right? The trend of the market, the trend of the sector, and the trend of the stock all working for you. That's exactly what he's saying.
You want everything to be put all the trends in your favor, and that's what I call stacking probabilities. You want to stack probabilities. When you start stacking probabilities, it becomes multiplication. It's not addition. It's not 1 + 1 + 1 probability equals 3 or 4. It's a multiple of that. When you start putting all these things together, they give you a much higher probability. I'm always buying in the direction of a trade. Here's an example, and I'm going to show you some examples here in just a minute. We're going to show some charts.
Ooh, let's go. I wonder if I can zoom in slightly. It says it's zooming, but it's not doing anything. I can zoom in on my phone.
And some.
Guess I can't zoom in on the. Oh, we can up the quality. Oh, now you tell me. Why wasn't that quality even higher? Sorry about that. All right.
So I'm going to show some recent trades too that I've just recently done. So this is WR Grace. At the time, they had some asbestos issues, and they started to get them resolved. I forget, but there was court cases and so forth. But the stock set up really nicely. I remember, if I remember correctly, there was a correction in the market in 04, and this came right out of just a perfect VCP pattern, just beautiful. And you see, I'm buying it as it turns up. And this is another thing I wanted to have Dave talk about, because back when I was just starting out and I was reading the very beginning issues of Investors Business Daily, and I actually attended a seminar with Bill and David. It was like it was right in the beginning too, because there was like 25 people in the room. No one even knew about them at the time. Dave said something, and I never forgot it, and I've been living with this principle ever since. He said the best thing that I know I'm going to have a profit in the stock is that I'm up right away on it. Usually the best names and the biggest gains that I've made are profitable right away. And I found that when I look back, because I keep a record of all the trades that I've made, and we do a lot of post analysis, we find that that's so true, that when the stock gives you a hard time from the beginning, it usually ends up being a poor performer. And when they're hard to buy and they just come out and you wish you bought more, this is a perfect example where you see just came out and it was up. I held on to this stock for quite a bit. I didn't make the full 147%, but I made a big move. It was close to 100% in a pretty short period of time, just a couple months. And the reason was, and this is an O'Neill rule basically, and I don't always follow this, but coming out of a bear market, if a stock shoots up 20% in a very short period of time, and the pullback is very shallow and it recovers very well, I usually hold that longer and give it, because it's shown me such strength. Here's a recent name. This is Shaq. I was in it for a trade, but you can see same principle. I'm just buying it off of here. This is what we call a cheat area. It's basically just a low handle, if you will. Sometimes you get a few different pivots and handles that will form. If it's in the very lower third, we call it a low cheat. If it's in the mid third, we call it a cheat. And if it's in the upper third, we call it a handle. And that would be the classic O'Neill cup with handle. But you can see as the stock, it goes through this consolidation, as it's turning up, that's where I'm buying it. And then I'm at a profit right away. It gives me a little cushion. I'm able to go and hold into earnings and take advantage of the gap. So, and then I actually sold it too early into this gap. And I think I sold some a little bit right up here, and then it drifted a little bit higher there. Okay, let's talk about another principle of minimizing drawdowns. So another thing that I do that I really feel like this is one of the absolute most important, and the things that have been the principle that has been most responsible for me not having big drawdowns, and that is that I always expose progressively. And what that means is that I never just plunge into the market on my opinion. Even if things start looking really good and everything starts taking off, I'm usually just putting a toe in the water, and I'm going to take a few trades. And if say I'm in 100% cash and we're in a correction.
So he's in cash? What? One of the greatest traders ever talking about being 100% in cash? No.
Some stocks start setting up, they start emerging. I'll usually, we're in a correction. Some stocks start setting up, they start emerging. I'll usually go to about 25% invested. If things are really looking good, I might go to 50. But usually my first toe in the water is 25% invested, and I might buy 2 stocks at 10 or 12% positions, or maybe 4 or 5 stocks at 5% positions, just a toe in the water. If things start working, I move it up to 50 pretty quick.
I also heard that noise, and I started looking around like, is my house collapsing? What was that noise? It was not here. It had to have been in the video. That was crazy. But you know, to this point right here, if Mark sees one of his setups, he's going to take it, and he's going to take the right position size that he's going in with. And I could imagine he would go from 0 to 100 just as fast as he needs to if he sees the setups he's looking for. So I'm a little surprised that he's talking about expose progressively, meaning get in at 20%, then 50%, then 75%. But yeah, that's a little surprising that he'd say that. But you know,
quickly, and if they work from there, I try to go to 100 as fast as possible. But I'm always pyramiding on my success. Now, let me explain why this is important. And this is a key sentence, all right, that you should always remember. If you build into your exposure when you're trading well, when things are going well, and you scale back when things aren't going well, you're going to get whipped around every now and then. You will zag against the zig, if you will, but what's going to happen is when you finally get into a bull market or a bear market, you're going to be trading at your largest when you're trading your best, and you're going to be trading your smallest when you're trading your worst. So it will protect you in the bear markets, and it will make sure that you're invested heavily in the bull markets. And that's all the noise in between is going to be there. But this is where it really all comes down to, is when you have to make the money in the bull market and you have to keep it during the bear markets. Now, very simply, let's just use a full position at 25%. We'll call a full position 25%. So a quarter position will be 6.25%, right? So let's say I go in there, I risk $500, and I'm trying to, be a 2-to-1 trader. So we'll just use, once you get a 2-to-1 gain, you're selling it. So I take $1,000 profit. Well, now I can take that $1,000 and I can bump my position size up, and I can risk $1,000 and go to a 12.5% position. Now, let's say I get another profit. I can now move that and risk 2,000. So maybe I lose on there. I still have $1,000 left over. That's in my P&L. That can now finance a half position, and I can go through this whole cycle and not lose anything. Okay. Now, if things are working and I start pyramiding at some, maybe say, well, who the hell wants to break even, right? Okay, but if things are working and I keep pyramiding and things work out and I don't get stopped out of these names, now I've got myself at a nice invested position, and I've really positioned myself well. But if things,
okay, so I'll give some of my perspective on pyramiding. I'm gonna 6 drawings here. Let's do this. Let's use SoFi as a great example. So one thing that Chris used to do is, let's say that Chris got in here just as example, right? Let's say that this was my entry point. And then as it goes up, every ATR, Chris would buy the same number of contracts as it went up, right? So if I'm buying 10 originally, I'm buying another 10, I'm buying another 10, I'm buying another 10, right? Now, as great as this was, and it was great when it worked, right? I just sent out one train. I just sent out another train. I just sent out a third train. So I now have 3 trains working for me, and things are awesome. But what happened more often than not, which is why I don't do this anymore, is after I sent those 3 out, all 3 of them would end up turning around and come against me all at once. And so what started off as a big, beautiful, lovely trend, when it reversed, all of my gains would be wiped out so fast because I had 3 times as much position size coming back against me than I originally started winning with. So I don't trade like that anymore. I don't pyramid up into anything. I don't dollar cost average in anything. I put in my position size at the beginning and I let it run. And that's it. Right? Makes it a lot simpler too. But I don't do that anymore. And that's the exact reason why.
Turn around on me, I'm out of the market. So bending, just bending with the market, bending with the market. I know, Dave, I know that, you know, you're a toe in the water guy too. You know, you're not going to just jump in. And any, you know, we all have our own sort of little ways we do it and rules that we do. I know, you know, you and I are both, you know, more conservative than we used to be. You know, we're not putting our whole account in one name anymore. Any rules for, you know, or guidelines for, you know,
Yeah, I
exposing
usually
progressively?
I determine now I usually go. I start with I have 10 stocks in my portfolio, and when I'm buying a position, a new position, that's going to be 10% of my portfolio. I usually start at a 5% position. I just figure what I'm going to put into that count, and I start with a 5% position. And if the stock starts working out pretty quickly, then I move that up to 10%. You know, sometimes it might be the same day, but lots of times it's the following day or the third day. And so I constantly just adding money to positions that are already starting to work for me. If that 5% position starts down and starts coming off, I'm not going to be adding any money to it until I can see it's holding and starting to go back up through new highs. So it's going back to that principle of always adding to winning positions and not adding to losing positions. And then as time goes on, if I have a nice 10% position and that stock makes a nice move and it's, you know, I'm up 20 or 30% and it builds a whole new base, well, I might even double the position at that point, because if you can get 1 or 2 great stocks in a year and you add to them on progressive basis.
And that's such a great point. If it's running and it doesn't turn around, pyramiding is huge. It'll grow your account bigger than you ever thought it did. But it's when it turns around, right? That when it turns around, that's the part where it hurts you.
That's where you're going to make up for all the small losses you might take and have great gains over a year period of time in your account.
Yeah, and this really goes right, you know, and flies in the face of what I see a lot of people, they tend to revenge trade. So if they start to have losing trades, they'll ramp up their exposure and try to get it back quickly and start doubling up, and that's how you blow yourself up. You've got to be humble, all right? I've been doing this now for over 3.5 decades. David's been doing it for 4 decades, and we still have to cut our losses and admit when we're wrong. You know, we haven't gotten so good where we're not going to have losses, and you're not going to either. So you have to realize that, you know, revenge trading and trying to make it up and going in there, you've got to bend. And sometimes, you know, I get people like they'll send us emails and messages on Twitter and say, you know, oh, I scaled up and then everything started getting hit. Then I scaled down, everything started taking
That was me. I might have sent him that message.
Off and it's not working. Okay, but again, that's the noise in between, but that's the price. It's like an insurance policy. Okay, that's the insurance. That's the small price that you pay to keep yourself in the markets, the good markets, and heavily invested, and out of the markets that are poor. Just a quick note too, if you're looking at, you know, some of these charts and they have low prices, some of them might even show, you know, it's pennies. It's just, they're split adjusted, so they're not the actual price. I'm not buying, you know, stocks that are trading at 20 cents or even usually $10. It's usually going to be
Just why?
you know, higher priced names. So the next,
Because Mark's a snob like me. That's where I learned that from, by the way. Don't buy the cheap stocks. They're cheap for a reason.
thing that I do, and that really helps me with my drawdowns is that I protect my break-even point as quickly as possible. Now, there's a little bit of latitude there, or that's that's a relative term. The key is not to choke the trade off. You want to protect your break-even point as quickly as you can, but give the stock enough room to fluctuate normally. And that's what takes time to learn on what is a normal action and what is abnormal action. When you know what's normal, then you know what's abnormal, and you know when you have to get out of the trade. So what I normally do is if the stock is, it moves up from, let me see if we have a chart here. Yeah. Okay. So here's an example of a recent trade not too long ago. In January, it started rolling over. The market went into a correction here going into February, and this stock, went right in as the market started to top there. But I bought it coming out right here. You could see a little base coming out. Stock ran up, and because the market got a little heavy, I actually sold a little up here, and I cushioned myself a little bit. And then it came in, and I got knocked out at break even right here. And then of course the stock went a lot lower. The market corrected. Now that's how it happens sometimes. Sometimes I won't even sell any as it turns up. And
listen, Market Wizard, two-time U.S. investing champion, just talked about how he put on a trade and he got out at break even so it wouldn't turn into a loss. How many times have you let this happen and you held it because you're like, I can't take a loss. I can't do that. And then it's gone down like this on you, right? It's super common. It happened to me for ages and ages, right? If the stock comes back, that is it telling you it's not going to work. Right. I believe David Ryan is the one who said a winning racehorse doesn't back up into the gate. And this is a horse that backed up, and that's fine. You just get out and don't worry about it.
And what I normally do is if the stock goes to its first pullback and then goes into new high ground, I'll then move my stop to break even. And I usually don't move my stop to break even. I stick to my original stop until the stock goes through a first natural reaction and then gets into new high ground from there. And then the break even point becomes a critical level that I'm usually protecting. And then from there, let me see if we have another example. Okay, so here's another example of, where sometimes, it hoses you. Here's a perfect example. I bought this stock back here in June. And it came out of a nice big base here, nice tight pivot point, came out really well, and you can see it had a little natural reaction, then went back into new high ground. So that's my cue to move my, and you know what, I should be using I'm sorry, I should be using a pointer. There we go. Here we go. Sorry about that. I'm thinking the whole time you're seeing my pointer. So right here, we break out. We come to a little natural reaction here, and then we get into new high ground. So then I move my stop up to break even. Unfortunately, stock came back really quick, knocked me out, and then ended up taking off. Now, that happens. That, like I said, that's the price that I have to pay. Sometimes it's going to happen. There's other times I move my stop to break even, keeps going. I ratchet it up, and I end up taking advantage of a big gain. Again, it's all about what you do over time and what happens on average, not any one particular trade. If you're going to Monday morning quarterback and say, oh, well, I should never do that again, that's like saying, you had aces, and which is the best starting hand in poker, and you lost with them, so you say, I'm never going to play aces again. Mm-hmm. Well, that wouldn't be too smart. That's the best starting hand you can have. Or you win with a pair of threes, and then you think, I should always play a pair of threes. You don't judge. Stock trading is about probabilities. You have to think over the long term. You're going to make hundreds of trades, thousands of trades. You have to be able to do something over and over.
Mark, if you go back to that, one thing, and I do this a lot. Let's say you did buy it on the breakout and the stock pulled back and then you got sold out, and then it came back up and it set up again. Well, this stock gapped, but if this stock started breaking out and it wasn't too far extended and it came through that 48 area, you can buy it back. That's where your ego, you have to throw your ego into the trash can every time you step into the market, because just because you lost money on it, you step into the market, because just because you lost money on it, you took a small loss, doesn't mean that you can't buy it back again. And sometimes I've lost money 2 or 3 times in a stock, and finally I buy it again, and then the thing just takes off and goes. So that's where the ego, or you have to just dismiss it and look at every
Yeah,
situation.
and that's getting
brand
into
new.
more advanced techniques of that. That's what we call a reset. There's a pivot reset, a pivot failure reset, a base failure reset. These are things, of course, that we'd have to spend a lot more time on. But absolutely, David is 100% correct. You don't think that the stock has it out for me, or that it's bad. This stock's bad luck. If it sets up again, the fundamentals are there. Just because this stock stopped me out, it's highly unlikely that the fundamentals change that dramatically.
Okay. That's the first time he's mentioned fundamentals. We're like 85% through this video. First time he's mentioned fundamentals. Because as much as Mark says that he likes the fundamentals and all that kind of stuff, what do you think is actually going to pay? Right? How often do you think that the fundamentals, which change 4 times a year, are going to influence his decision? Probably very little. When 99% of the time, 99% of the days, there's no fundamental news coming out, yet there's all kinds of stuff going on the price, right? Price is what matters. Price is what matters beyond everything and anything. And that's why we've spent the entire video so far following the price. Yeah.
In just a few days, unless this was on some key report that had some horrible news, but it wasn't at the time. So you could still have all the fundamentals are there. Let me just move on here. I know I'm kind of pushing a little bit quick here now because we're running tight on time. Let's see. So here's another one. This USAK. It's a trucking company. Real tight. I bought it thinking, as for a trade here. It had a nice. It came out of the gate pretty nice for a few days, came back, and a lot of times what I'll do is I'll either sell some of it as it runs up quick and then move my stop to break even, or what I'll do is I'll move my stop to break even on half my position, and then I'll maintain my stop on my original stop on my other half. And that's what happened this time, where it came back, it knocked me out of half, but then it was able to move up here. I got a nice gap on it. It took off, and I sold it into that rally and had myself a little profit on it. Finally, let's talk about selling into strength. And again, this is really the hallmark of a professional, is to sell. Amateurs get all enamored when the stock's going up, and they start having all kinds of illusions.
Dreams of Lambos, things like that. This has been a game changer for me, selling into strength. I mean, I have come out of trades, and not that I've perfectly timed them or anything, but selling into strength when everybody else wants to buy it is actually really awesome. Now, does that mean you're giving up part of the trend? Yeah. So let's look at SoFi as an example. Let me remove all these drawings here, right? You can sell into strength anywhere on this way up, and you're not going to have any issues getting out of it, right? But when it starts having closes under that 10 EMA, a lot less people are excited to buy it from you, right? Now, you're not going to really have any issues. This is a super liquid stock, but especially in options, if you're selling it into strength while it's moving up, you can actually get really, really good fills versus trying to get out as the trend starts to bend. Let's go to Tesla over here. Trying to get out on this side, your option price is tanked, right? It may be down multiple tens of percents from what it was just a couple days prior because you're selling it on weakness. So if you can sell on strength, if you have a way to sell on strength, that is the best way to sell out while everybody is excited to buy it from you. I'm telling you, it's great.
Is that the thing's going to keep going forever, and then because a lot of times the momentum is so great, they'll sell it and then it'll go higher, and they'll think, that was a dumb thing to do. But again, you can't Monday morning quarterback. You're not going to get the high. The chances of you getting the high even once in a blue moon are almost zero. So it's fruitless. You shouldn't even think of that. What you're trying to do is make a decent profit. Just make a profit and make more than you're risking, and do it as many times as you can that it's meaningful enough for you to be able to compound a nice big return at the end of a year. And here, very simply, I'll show you a way that I, played a recent trade. This is Shutterfly. We were actually talking about it today, David and I. It's now, the stock is topped and looking like a short, maybe. So it comes out of this power play here. Some people call it a flag. It comes off a little cheat area coming out. A lot of times these little flags, I'll buy them coming out of the cheat area. So I buy it here. It runs up, and I reduce my position, and then I move my stop to break even. So what's happening now is I'm free rolling the trade. I'm going to make money no matter what, unless it gaps down and gets this giant gap.
This is how I do with rolling the trade, right? He does it in a different way. He can't roll options like we do because he doesn't trade options. But rolling options is exactly what he's talking about here, right? Taking those partial profits off the table while they're there for you. Go take them.
Maybe on news, it's the only way I could lose money on this, and would have to gap quite a bit because, of course, I've already nailed down a profit. Now, as it started to go through this basing period, I was actually going to add back to it, and very often what I'll do is I'll trade around my position. So I'll trade out of some, it resets. As it turns back up, I'll trade back in. So I hold part of it, I trade part of it. That's called trading around your position. But what happened was it gapped out. So instead of having the opportunity to buy it coming out, it got ahead of itself so quick that I actually just sold it and took the profit. So this is just a very typical way that I'll play a swing trade. Let's see. So this is another one recently, not too long ago, GTHX, where I bought it again. Very similar. You see almost the identical type of trade where it's a very high momentum, corrects, doesn't correct much, and as it comes through that low cheat, I start buying it. I sit through it as it consolidates. It runs up. I'm up 23%. I reduce the shares. I sell some of my position. Now I'm up almost 40%. I sell a little bit more. Now I start backstopping it, and it was up. It came back in where I was only up 22%, and I decided that's it. I'm out, and stock came in from there. But I just stuck to my original stop until here's Netflix. This is a recent trade in Netflix. So I bought Netflix. You can see it was putting in this base. If you'll notice, everything that I do has VCP. Okay, for those of you that understand VCP, you know exactly what I'm talking about. For those of you who don't, you should refer to my books and also to O'Neill's book about look at the coupled handles and look at what we're talking about and the characteristics that should happen while you're getting these price consolidations. You can look at charts going all the way back to the 1800s. Same thing, timeless. This is never going to change. It's simply the law of supply and demand on display. So I'm buying it here, right? It's coming out of this nice little tight area. We run up a bit, I reduce some. We run up some more, I sell it into this strength. So again, you see, I'm using strength. I'm almost always selling into strength unless I'm being forced out and it's coming back in. Then I'm being forced out of the stock. But I don't want to give the stock a chance to break. I don't ever want to give the stock a chance to break. I want to get out when the getting's good, because what can happen is, like, say I wait here and I keep waiting and backs and say, well, let me see until it starts rolling over. And then look at here, wham. You give up all this ground in such a short period of time. You would have been better off selling it on this first rally phase and not even waiting. So a lot of times if you get out when the stock's up, you'll do better than if you use a moving average or something and wait for it to roll over and to have a trailing stop. So I'm always trying to sell into strength. Dave, are you, when you're at a profit, are you using strength for selling? Has that been part of your repertoire for a number of years?
Yeah. Yes, at times when the stock is, and the thing about this stock is, if you can watch my pointer, it was going up at this angle, and then it started almost going straight up. When I have a stock that's going straight up like that, I watch it very, very carefully for signs of a top. And
reminds me a lot of this. Same with HIMS, right? HIMS did this, and then it crashed back down. Is HIMS doing it again? I don't know, maybe. But that's what David Ryan's talking about there, is when you see those irrational, those exuberant moves, right? That gets scary, right? Now, it's not scary if you're holding it and you know what to do where you're going to get out. It's a lot of fun. It's the best ever. But there's a lot of people who accidentally got into something like this. Their friend or somebody tells them, they buy it, they watch it go all the way up, they're counting their Lambos, and then it's gone. And they're down so much money because of it. And then they get the opportunity again. And they're like, oh my God, I knew it. I knew I should have held on to it. And it's gone. And then they get the opportunity again, right? It plays out over and over and over. Your job as a trader is to have that plan when it is moving like this, to recognize, okay, this is fine. I'm not stressed. I'm not counting my Lambos. I'm waiting until I get my exit plan when my exit signal is hit, getting out, and then go count your Lambos, right? Because if you do have the plan, you'll be getting out somewhere right here, right? You're not going to catch the top, and don't ever try. But maybe you get out right here under the 10 EMA, and then it collapses underneath there. And you're laughing at everybody who's holding it down here. And they're doubling up and tripling up saying, oh, it has to come back. It has to come back. And then it comes back up like this. And they're like, oh, I'm so smart. And then it crashes back down. Oh, right. Trading doesn't have to be emotional. Not at all. Especially when you follow your plan.
When I see a reversal on volume, or here it looks like it had an inside day and gap down, I do look to cut down the position. I don't want to lose the position because it's usually a very, very good stock, but I will cut it back, and I'll cut it back.
Dude, it sounds like they need to be trading deep in the money long options. If they don't want to give up the position, they can roll the options, keep the trade alive, and take partial profits at reducing risk all in the meantime.
Dramatically if it starts showing those signs of topping. Well, what this one did, it looked like it started building a whole new base again, did not break out, but actually broke down, and that's where the rest of the position, if I had owned this, would have been gone. But I look to see those signs of when something is getting very, very excessive, and there are some signs where we've had some technology stocks recently that have had those signs of excessive moves to the upside.
I think from Learning 101, this is a brilliant question. Is it not contradictory to buy and pyramid up and also sell into strength? I can absolutely see that, right? Because it wouldn't surprise me at all if on Mark's chart, he said he bought here, he added a position here, and then he sold it right here, versus bought here, sold into strength, and then sold the rest of it. I don't trade like that, so I can't really speak to it. But again, right? It makes sense to me what you're saying.
Yeah, and if I was in much lower and I have a very big long-term gain on it, maybe playing it for a big move, I might wait for it to break down a bit, and I might give it that type of room. But what I was doing here, and to David's point, is I started to see these FANG stocks really starting to get very popular and what I call crowded, and I was looking for some type of blow-off move, and that's sort of what we got here. This is sort of a little mini melt up. So I'm just going to sell right into that because I know that's going to break hard once it comes in off of that. So I'm in the later stage of a bull market, I might be treating things a little bit differently. If I was, buying this stock coming out of a base off of a bear market, I probably wouldn't be selling, any of my shares here, or maybe reducing a little bit, but I'd be holding for a much bigger move. So really, it depends on where it occurs.
Yeah, and Mark, on one recent example, someone asked. I saw someone asked the question: do I still own Ollie? It's Ollie's Bargain Outlet, and I still own it, and I've owned it for over 2 years now. But there have been times where the stock, just even recently, had a really nice run from 66 to 90, and right before earnings, I cut back on the position to take some profits because that thing was going straight up into an earnings report. So that's an example of selling into strength when it's so good and it's had such a good run. It's time to reduce the position and just take some off the table.
Yeah, and Ollie's, that's a name that David and I bought, I think, on the exact same day. We bought it coming out of that nice IPO base, and I traded out of it, and then I got back in it and traded out of it, went back in it, and he's been holding it pretty much the whole time. I'm pretty sure he's way ahead of me right now as far as gain on the stock. But again, you can trade it different ways. You can trade around your position. You can, but here's the point I wanted to bring out, and Ollie's is a good example. Ollie's is a name that if you were to ask the average person about Ollie's, I doubt, but a few out of 100 would know who Ollie's is. I happen to know because there's one nearby in my neighborhood that I go to it every now and then. But most of these big winners are big winners before they become household names and everybody knows them. Again, I'm going to swing back. I wanted to start with the FANG names and the Amazons, and I'm going to end with those because you really have to start to move into areas that you might feel uncomfortable with. Smaller names, relatively smaller names, small mid-cap names that you haven't.
Oh, listen, I had this conversation with another market wizard, Tom Basso, when he and I were working together. It was a day when I just happened to have bought a stock that I'd never heard of before. And I was like, Tom, do you ever do that? And he goes, yeah, of course, all the time. Like, who cares, right? If the price is moving up, that's what I'm after. Even if I've never heard of them before, I don't care at all. If the price is moving in the direction that I want to see, I'm interested in trading it. Charlotte has a question. Do you ever reduce position size when rolling? No. So for example, let's say I had 100 of 100 option contracts and I'm rolling up to a strike closer to the money. I'm going to have the same number. But in the process, I'm taking risk off the table. So therefore, I'm reducing position size inadvertently, right? Profitably doing so, I guess is a better word to say so, but not in number of option contracts.
Heard about technologies that might be new technologies, that's where you want to look. When I was buying the Amgens and even Microsoft and Dell and Cisco and Amazon, when I was buying these stocks, before they made the really big moves, let me see, I know we have some charts. Here's Yahoo. I'm buying this in 97. Nobody, I always make the jokes. I went to the institutions and I said, you got to buy Yahoo. And they said, Yahoo? What are you talking about? That stock trades at 938 times earnings. And I'm like, yeah, but it's breaking out of a base and it's this incredible technology. And, and everybody just laughed at me. And then the stock's up 8,000% 2 years later.
Right. Fundamentals. How big of a difference is that? Right. Does it matter at all? Not in the least. To Mark's point, exactly. It had whatever X hundreds of percent price to share. Who cares? You're only going to get paid if price is going up. That is it. That is the only time you get paid.
These are the type of names that, again, if you take a look at, I'm just going to go past that. Amazon. Here's where I'm buying Amazon. This is my first purchase in Amazon. Amazon goes up 2,500% in just 16 months from this point here, and almost 80,000% over the next 2 decades. Now, you want to buy Amazon now and hold it for 20 years? I could tell you right now, you're not getting 80,000% out of it in the next 20 years, and I doubt you're going to get 2,500% in the next 16 months. Okay, but that's when, at this point, nobody even knew Amazon, and those who did hated Amazon. Amazon was one of the most hated companies for as far as I can remember. It's only in very recent times that people started saying that Amazon could even make money. It was thought that Amazon would never make any money. So you want to find the next Amazon. And I hope everybody, this has been helpful. I know
kind of an abrupt end there, but you know what? I am super stoked that we got to listen, right? You just got coached directly from 2 market wizards, all for free here for free on YouTube. So listen, if you are ready to save time, make money, and start winning with less risk, click one of these 2 buttons and have a fantastic day. We will talk soon.